Another one bites the dust. You came here for the truth, so let me unveil that for you. Today, we are going to talk about this one particular company, Archegos. And essentially, what you're seeing here is one company who took too much risk and it's now pulling the rest down with it. We're going to look at who's involved, and let me just give you an idea very quickly of what's happening here. What's the deal? Archegos defaulted on margin calls from several investment institutions. Which companies are directly involved? Credit Suisse, Nomura, Goldman, and Morgan. We've got many companies that are going to be coming out in the next little while. We'll find out all the details. That's what I have for you now. We're going to look at everything that's happened up until this point. There's a lot of deep and dark things going on behind this company. And of course, with the head, I believe the pronunciation is Huang, but we're going to see exactly how this has all come to be. I'll give you all the details, and then if we have time at the end, I've got a lot of information to share about a different topic, so let's get into it right away. U.S. regulator is monitoring Achegos Capital Management situation. Okay, don't worry, the SEC is looking into it just as they looked into, by the way, what they have also linked to this, and that is LTCM. And, you saw what happened with that and how that really pulled down the markets at the time. It really created some serious problems for the financial companies throughout that period. This maybe could be something similar. It's too early to tell at this point, but right now I just want to cover the info and let you know that the SEC is going to save the day. Well, the SEC said is monitoring the situation after a hedge fund defaulting on margin calls prompted major banks on Monday to flag that they were facing big losses. All right. So when you go into this a little bit further, you start to realize that a lot of these companies take a lot of risk and it's hidden, and the average person cannot see what's going on. And this explains exactly why they can't see what's going on. Non-disclosure. Billions in secret derivatives at the center of Archegos blow-up. Archegos used equity swaps, or CFDs. Instruments are popular with hedge funds and allow non-disclosure. We're talking about billions of dollars, not millions of dollars. This is not necessarily a very small company. And the problem that I have highlighted here for 10 years on this channel is that derivatives are far more dangerous than they let on. You have a problem that exists here. Let's say these are all different companies. These are all different types of investments, but they are all connected to each other, not just by one link, but oftentimes by many different links. And if one of those begins to fail, you start to have problems with all of the rest because it's all interconnected, and derivatives are the center. I've talked about this in both of my books. I talked about this really all throughout on this channel for 10 years. And you do see these instances where things start to unravel. This is one example of that. Swiss bank Credit Suisse said on Monday that it may have suffered a, quote, this is a quote, highly significant loss from a default by a US-based hedge fund on margin calls that it and other banks made last week, while Japan's Nomura said that it could face a loss of $2 billion due to an event with a US client. So right here, we only have these little tidbits, but of course, as this starts to unfold, I'm going to bring you the information. I'm sure you'll see it for yourself in the news as well, but this is important, very important to watch out for. Following the failure of the fund to meet these margin commitments, Credit Suisse and a number of other banks are in the process of exiting these positions. So then we find out what the losses are, and then we also have to know who is involved, and that's going to come with time. A margin call is triggered when investors borrow using their stock portfolio as collateral and have to make up the balance required by banks when the share prices fall and the collateral is worth less. But you don't have to worry, right? Nothing can happen. Nothing bad can happen because the Federal Reserve is going to fix it, right? I mean, I see that all the time. I see that every day. The Federal Reserve is going to fix it. But will they? Credit Suisse said that, quote, while at this time it is premature to quantify the exact size of the loss resulting from the exit, it could be highly significant and material to our first quarter results, notwithstanding the positive trends announced in our trading statement earlier this month. The forced liquidation of more than $20 billion in holdings linked to Bill Hwang's investment firm is drawing attention to the covert financial instruments that he used to build large stakes in companies. This right here is an article out of Bloomberg, and there's a lot in here that I've pulled up just within these few that you need to actually read through in full. I'll just give you sort of the insight you need to know right now, and then as it unfolds, I'll give you more. Much of the leverage used by Hwang's Achegos Capital Management was provided by banks including Nomura, Credit Suisse through swaps or so-called contracts for difference. According to the people that apparently know what's going on, it means that Archegos may never actually have owned most of the underlying securities, if any at all. Derivatives, my goodness, derivatives. Sometimes, I've said this so many times before, they don't even need certain things to create this fictional value out of them. And then people say, well, you know what? I don't need to worry about that because I'm invested in these companies and they're solid and so on. But those so-called solid companies might be investing in the garbage, and that makes you accountable for this. And that's the unfortunate thing that we see, especially when people are getting into, let's say, ETFs. They're just buying the whole market. Well, they don't realize how it's so interconnected. Well, look at this. Investors who own a stake of more than 5% in a US listed company usually have to disclose their holdings and subsequent transactions. That's not the case with positions built through this type of derivatives apparently used by Archegos. The products which are transacted off exchanges allow managers like Hwang to amass exposure to publicly traded companies without having to declare it. You don't need the 13F that we normally cover here on the channel. You can sidestep all of that. Now that kind of leads to some problems along the way, but hey, let's just let it all continue. Let's let billions and billions of dollars of things that don't even exist. It's up in the clouds here, and you could do whatever you want, but the problem is it's not a laboratory. Look, I think people should do whatever tests they want in the laboratory, but once you bring that into the real market, you start affecting real people, and that's the danger. The swift unwinding of Archegos has reverberated across the globe. Banks such as Goldman Sachs, Morgan Stanley forced Hwang's firm to sell billions of dollars in investments accumulated through highly leveraged bets. The sell-off roiled stocks from Baidu to Viacom CBS and prompted Nomura and Credit Suisse to disclose that they face potentially significant losses from their exposure. Okay, some of the things I repeated there from the previous article, but it's important to know who's really affected by this and how the market is going to take it. Okay, I really want to get into this in depth as much as I can anyway from what we know right now and really give everybody as much value as possible. So this really extends that. And you could see that one reason for the widening fallout is the borrowed funds that investors use to magnify their bets. A margin call occurs when the market goes against a large leverage position, forcing the hedge fund to deposit more cash or securities with its broker to cover any losses. Archegos was probably required to deposit only a small percentage of the total value of the trades. And of course, as long as everything's moving up, as long as everything's all good, hey, there's not going to be a problem. But as soon as you have one little bump in the road, everything falls apart. The chain of events set off by this massive unwinding is yet another reminder of the role that hedge funds play in the global capital markets. The idea that one firm can quietly amass outsized positions through the use of derivatives could set off another wave of criticism directly against loosely regulated firms that have the power to destabilize markets. Let's not talk about the 800-pound elephant or gorilla, whatever the statement is. Let's not talk about the Federal Reserve, okay? Because the Federal Reserve, oh no, they're completely out of this. I mean, we we shouldn't look in their direction at all. We should be ignoring every single thing that they say because, they're just trying to help. So they're not really doing anything to actually destabilize this whole market with their extremely low interest rates, telling everybody all the way through 2023 there's going to be very low interest rates and that they're going to print more money and that they will print more money if they're encountering any problems in the future. So take as much risk as you want. Any company that gets some sort of fine or anything is going to be a slap on the wrist. You don't have to worry. So go. And that's what's been happening. And these type of things are what you get as a result. Boom and bust, the value of the portfolio of positions block traded dropped 46% in the last week, erasing 2021 gains. So you could look at some of the stocks that are up there, but I just wanted to show you how quickly things can change. That's all I'm trying to highlight here. One part of Huang's portfolio, which has been traded and blocked since Friday by Goldman, Morgan, Wells Fargo, was worth almost $40 billion last week. Bankers reckon that Archegos net capital, essentially Huang's wealth, had reached north of $10 billion. And as disposals keep emerging, estimates of his firm's total positions keep climbing. Tens of billions, 50 billion, even more than 100 billion. It evaporated in mere days. Quote, "I've never seen anything like this, how quiet it was, how concentrated, and how fast it disappeared." Now, then right here, he said, basically, this has to be one of the single greatest losses of personal wealth in history. But look, what about the accumulation? Does that really count for anything if you're making it out of thin air? That's what I want to know. But of course, they're not going to necessarily look at that. And all of the other companies that are doing the exact same thing today, you think this is the only company that does this right now, that's doing this currently? I bet those individuals who are sitting on their beachfront property right now running this type of game, I guess you can call it, dangerous game, they're probably sweating a little bit right here. They're probably a little bit nervous, but they're going to continue it on until it fails. The initial image here that I showed you at the beginning, I referred to the deep and dark part, and that's part of what I'm showing you here. It's another Bloomberg article. Huang was an earner, and some firms such as Nomura, Morgan Stanley, Credit Suisse were happy to play in his world. Even Goldman eventually succumbed, reportedly lured by lucrative trading commissions that convinced it to remove Huang from its blacklist. They all channeled billions of dollars to Huang so that he could keep his fire hose pumping. When he couldn't make good on his debts, he got a margin call. Wall Street parlance for pay me my money. Again, if you've had a sinking feeling when your credit card bill arrives, you get this. And just prior to this part I'm showing right here, essentially he was barred from making any of these trades because I think it was a 4-year period because of insider trading. He was in big trouble previously, and then he started up this company, a family office, and it looks like he got himself into more trouble this time around. But look, as we go on here, Huang was able to mask some of his trading and debts as well, I would think, by engineering his moves using derivatives such as swaps. Market insiders may have known Huang was behind some of the stuff he did, but did any firm or trader know Huang was behind all of it? I doubt it. And then they make references to LTCM and so on. But I just think that this is more widespread than they are willing to admit. As a result of the chaos, you get this happening, and it happens time and time again. When we saw, back in, let's say 2011 into 2012, or the euro sovereign debt crisis, the euro viral contagion, all of that mess started to really create a CDS nightmare. And you saw this, in this case here, Credit Suisse 1-year CDS counterparty risk shooting through the roof. And why? Because they think now, suddenly, this is a very dangerous company because of their exposure. We don't know what's going to happen, of course, but I think it's important to watch what happens with the CDS, another derivative. But this is kind of telling you where the market believes risk is. and they believe Credit Suisse at this time is one risky bet. Two more quick points right here. You could see that the company is breaking its silence after soured bets prompted investment banks to hastily unwind its positions. Quote, "This is a challenging time for the family office, our partners, and our employees. All plans are being discussed as Mr. Huang and the team determine the best path forward." So they're going to see what happens, of course, here, and I'll bring you up to date as I can. Viacom CBS went from the top of the S&P 500 to near its bottom on Monday, being hit from all sides and erasing more than half of its value in just 1 week. Multiple downgrades, an ill-timed stock offering, and as a final blow, at least 2 large block trades linked to the forced liquidation of Archegos brought Viacom CBS down from a record $100 to $45. Stock fell 55% in 5 sessions. So right here, we know that there's some serious issues that are coming through because of this one company and the effect of that one company unfolds, and how many different we're talking about some of the biggest companies in the world, and their stocks are being pummeled 55% in just a few sessions. What are you going to do if that was you finding out about this? Do you hold on to your Viacom CBS stock? Are you just going to sit there with it, or are you going to sell? Do you think that this is going to be something that continues on for longer? Do you hold, what's the situation here? And I think a lot of people are not necessarily going to know what to do when it happens that fast. So this is a lesson that people need to learn about where their money is positioned, to do a lot more homework. It's not as simple as, hey buddy, give me the ticker. There's so much more to it. And unfortunately, a lot of people, they simply don't know what they're getting themselves into. Last thing to finish off the video, I'm sure you're already aware, just wanted to make everybody aware of this. Suez Canal has reopened to traffic after giant ship is freed. Vessels are on the move again in the canal, and it was there for almost a week. So this right here just gives you a little bit of insight as to what we could see, that temporary spike, and that might level off and simply we go on business as usual. It was able to be freed within a relatively short period of time, and the disruption maybe will be minimal. I'll keep tracking. If there's anything valid there that we need to be looking at, I'll bring it to you. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. By clicking a button on your screen, you help the channel out. Thank you. If you want to learn about e-commerce for free, you want to get the step-by-step, you can do this for free right now at the AmazonGPS.com. If you want to know about the financial system, all the details are right here in these 2 books. You can check them out at my link I have in the description there. And if you want the audiobook instead, that's available at themoneygps.com. Have you seen this video yet? If not, you absolutely need to check it out. Click it and I'll see you there.